The next is, do we involve the company to be signing this buy-sell agreement? Because this is a sale and purchase agreement between shareholders, usually the company doesn't get involved. But because most M&As at times require the company to approve the share transfer, so in the buy-sell agreement itself, we tend to say, get the company signed as a party. Okay? Because we do not want to be subject to the future board of directors, which we don't know who they are in the future, to now say that they don't agree with the share transfer, therefore preventing the completion of the buy and sell arrangement. So we make the company a party to it now. Who signs on behalf of the company? Obviously the directors, who is most probably the shareholders of the company as well. So we tie down the company this way. In the future, if they disagree, then too bad, they already signed already to agree. You have notice of that arrangement already. And life insurance. Life insurance, a quick one. All the life insurance that is part of this buy-sell, they will have to buy it in their own name. They do not buy it in the name of the company at all. Okay? Life insurance is important because it makes it easier for the purchaser to buy the shares of the seller. Okay? Without the insurance, purchaser will be paying cash money, whether lump sum cash or installment, right? Which is sometimes you can't afford. So having life insurance allow the purchaser to make the shares easily. Two, allow the seller to have certain guarantees that when he dies, X amount is immediately payable. He doesn't have to worry about the seller, doesn't have to worry about the buyer paying installment. Because you know in installment plans, pay a few times, most of the time you don't pay. So at the end of the day, if I'm selling my share for my dad and you're paying installment, I'll be worried. Because my family will now depend on you whether you follow the terms of the agreement properly or not, and pay every month according to the schedule. When you don't pay, my family will end up begging you, please pay, we need the money. Alright, okay? So we don't want that for the family. Having that insurance, both parties in a way will have a win-win. Without the insurance, no. I usually tell clients, if you don't have insurance, this is what will happen. I can do the buy-sell because whether you have insurance or no insurance, my fee will be the same. Alright? If you don't have insurance, I charge you more higher fee only in the future because as trustee, I got more work to do in the future. Okay, so my time cost is longer, I charge you more lah. I make more money without insurance. With insurance, I've got lesser work, therefore my fees also is reduced significantly. Because the moment the insurance receives one lump sum, if your instruction is pay out immediately, yeah, you just work for a while only lah. I'll probably work 2 months only, my fees is reduced to 2 months. As opposed to that installment plan where it says 60 months installment. I'll be working for you 5 years. And all the money that your family will get, deduct my fees. Alright, at the end of the day. Okay, so it's a choice that clients need to make. And the policies should not contravene Section 67. Okay. Are you familiar with Section 67 of the Companies Act? I don't know whether you'll come in the course of your work or not. Under Section 67. Without accounting records, it's actually basically company not being able to buy back its own share and all that. Very much Section 67, it says, number one, the company, Sri Lanka company, cannot buy back its own shares, okay? Unless you're a listed company that falls under Section 67A. 67 itself don't allow private limited companies to buy back own share. Number two, 67 also says the company cannot assist a shareholder to buy shares of another shareholder, including lending this shareholder to buy share of another shareholder. Okay? If you contravene Section 67, they've got a penalty. The penalty is 5 years imprisonment, okay, and or 100,000 fine. Okay? So if you use key man, that means company buy life insurance. Company owns the life insurance on the directors. The directors are the person that you insure against. And these directors and shareholders have a buy-sell agreement, okay, that mentions this policy that the company buy. And the company agreed also, when shareholder A dies, this company receiving money from the insurer will use this money, pay to A's family. In exchange, pursuant to the buy-sell agreement, A's family complying with the buy-sell agreement is to pass the shares of A to B and C as part of this whole arrangement. So when that happens, you go against Section 67 because it's the company indirectly assisting the other two shareholders by giving up its own money to help B and C buy over A shares. Otherwise, B and C have to come up with their own money, isn't it? So the company assists them to buy. So, sorry, you go under Section 67. So, keyman we don't recommend for clients to use for buy-sell. Right? In addition to the tax implication, because keyman you've got service tax, then you've got the corporate tax 25% to pay. Right? At the end of the total is 31%.
It's allowable.
No, it's not allowable.
Allowable expense.
Say again, sorry?
It's allowable expense, no. Keyman.
Keyman itself, not related to this buy-sell, you can sell, you can buy if you want. That's fine. Okay? So whether it's an allowable expense or not, depends on the guidelines under the Inland Revenue, under 2003 IRB Keyman guideline. That depends on whether the person you're insuring against has got 5% shareholding or lesser. If you've got 5% shareholding or lesser, and if this company is buying term insurance, then the premium the company pays is allowed as an expense. But then they whack you at the back lah. When the guy dies, it's not sure you can yeah. So I would rather you don't claim the expense in the beginning, you pay. At the back, you don't have to pay, really. Because small peachy sum that you're liable for. Plus, it's only the tax computation that you do year 1 year once, right? You can always increase some other expense to balance it out. Therefore, doesn't make a difference to you, right? Because if the guy dies close to your financial year end, habis lah. Got no way of playing around with any figures whatsoever or making some sort of expense. Just a $2 million payout. So we say, don't use Keyman, buy it online. Now, if you use Keyman, as I mentioned, this is just an elaboration of what I said. Okay, we skip this now. Right, this is what 67 says, and this is what the penalty is. So you take yourself. Right. Now, once the insurance the client buys, if they're using insurance, the policy needs to be assigned to the trustee so that we can hold that policy as the middleman. Whenever a shareholder dies, we will claim that interest money, transfer it to the seller's family. At the same time, use the power of attorney, transfer the seller shares to the buyer. Right? So everything is centered around the trustee to basically do the transferring and do the distribution of the funds. The policy that the client buys, we will tell the client, don't buy fancy policy lah. Right? You should only buy policy that are clean. For example, like investment-linked policy, term life policy, then whole life policy. But whole life policy, there are a lot of types. So don't go and buy those endowment plans lah. Don't buy endowment plan. Don't go and buy those plans where every few years give you money one. Those retirement plan or annuity plan, no, not for this buy-sell plan. Those you want to buy for your own self, fine. But to fund this buy-sell, buy those policies that only pay out when you die or suffer TPD. That's it. Nothing in between. Alright? So no hospitalization plan, no HNS plan, no medical card nonsense. Even if they give you free PA also you don't want. At the end of the day. So it should be a very clean policy. Only certain events happen, pay out and claim. That's it. Alright? Premium, I mentioned, director fee, dividend. Alright, it's a partnership, and put it under the expense of the partnership. Now, all first party, buy your own life. Buy your own life worth the value of your shares that have been agreed upon. Okay? Now, this is just some example where, if let's say all the all the shareholders are healthy, can be insured. This is how we would write it down in the agreement. We will say ABC are the shareholders. They will buy insurance on their own life. When they submit to the insurance company, they will name themselves as the policy owner, the payer, and the life assured. Okay? As if an insurance agent selling you policy lah. right? In the buy-sell agreement, we mentioned the purchasers are the one who will be paying premium for the seller. He's the seller, right? So these purchasers will contribute either proportionately or equally to this person's premium to buy over the shares in the future, in case he knock off first up, right? You will do the same thing for the rest of them. Okay. The bottom part is where only you state in the agreement. The top part is what you submit to the insurer. Right. Okay. Now, however, having said this, some clients they said, "You give me like that, a bit confusing lah. Can I do like this? I buy insurance my own life, I pay premium myself. Cannot." I said, "I don't mind. It can happen. Doesn't matter. So long as I don't have the insurance premium lapse, insurance policy lapse, I'm happy. You want to pay for your own insurance premium so that you sell your shares and get paid yourself, also can." Because that seems a bit odd lah. If my share is worth 2 million, I buy a $2 million policy, I pay 2 million premium on my own life, and then when I die, I use back this same 2 million to go and pay my family and sell my share. Rather than the other two guys pay for me lah. I don't want that. Okay? So long as the shareholders agree in this boat, we are fine. We're not going to insist on the other person must pay for you.
But this you're saying is you pay own, you control.
In a way lah.
The other two fellas halfway they before they don't pay.
No, it's simple. The way we do is, see, the premium, because all of it is going to be deducted from your director fee. So all you need to do is just give instruction to the company. When pay premium at a time, and when pay director fee at a time, deduct X amount in one check, pay to the insurer. At the back of the check, write the 3 person's name, how much premium to pay. The remainder amount, give it to us individually. That's it. So you never default, because all coming from company. Right? Unless the company got no money, that's a different story then. Because it's not going to be, company give you director fee, you write a check, then give. Like that show default one. Go in, never come out after that. Okay? That we be doing. That's what normally happens. And if some guy is not insurable, let's say this guy not insurable, sorry, let's say the guy is inactive, right? Not insurable. This guy, all the three are insurable, but you've got inactive shareholder, which is in a way an investor. What will happen is that in structuring the buy-sell, he would sell his shares to the other two, but when Mr. B dies, Mr. M will not buy. Because he's just an investor, no point for him to acquire more shares. He'll be just a seller. Right? That's how we'll go to it. If you've got some person who is not insurable, which is sometimes the case, this guy not insurable, what will happen is that the moment he dies, he has to pay cash. Sorry, this one I think you need to cancel, put that cash installment. Instead of sinking fund, you can just put that cash installment. So the guy will have to pay cash installment to buy out his shares. Okay, which is going to be happy and difficult lah. Why you cancel sinking fund? Because sinking fund never really works. Because you tell, I've tried it a few times to ask a few clients, why don't you create a sinking fund? Start putting money into a particular fund, buy unit trust. They say very difficult lah, because the thing is, the moment C got built up already, sauhan already, tangan gatal already, you want to take out. So they never leave that account alone one. So discipline is one problem. So they say, okay, never mind, fine. Since it's difficult for you guys, no point in the boss.
Let's ask you, can they challenge the valuation? You see, when everybody is happy, they say, okay, you buy 5 million life insurance. Then 5 years down the road, so it goes off, insurance company pays 5 million. But can they take out to the court of law and challenge? No, the business actually is not worth 5 million. It's only worth 3 million now. So by the 2 million should be distributed back to us as cash, and not all the 5 million goes to the beneficiary. Can they be challenged?
No.
No.
What is the last agreed price?
That's it.
Okay, that's it. Or last agreed formula, calculate formula, you calculate according to that formula, you get this figure, that is the amount. You can't challenge it. Unless you think that the calculation is not right, then it's a story lah. But if it's a fixed figure that you put down there, the whole company is worth X amount, and you didn't review this figure, and then the business value dropped, okay, which means the buyer is now paying more. Yeah, you're just paying more, that's it, too bad.
The inverse is also true.
Inverse is also true lah. And when it goes up, it's that, yeah, didn't review, I'm selling it cheap. So you're stuck with the last agreed value.
So they can't challenge in court.
Can't challenge. You can try to challenge when you lose.
It's like a willing buyer seller.
It's willing buyer, willing seller. Alright.
So the best is put a formula to how you want to
Correct.
value.
Then in the way you start. Even if you use a formula with your clients, it's best you also still do a review just to see your insurance coverage is on par with your formula or not that you use. If you keep on, your business keep on increasing according to this formula, but your insurance coverage is stagnant, you didn't increase it, you have a lot of shortfall in the future, which could be more than your insurance that you got covered for. So it's better to try have it on the same par, right along together as you increase, where it's possible and where it's still not too expensive. If it's too expensive, then it may stop. You'll probably tell the client if it's gone up too high, you may just want to stop agreeing to revalue. And then whenever got dividend, you'll just take only declare dividend more on a regular basis. They take whatever you can. So just leave the amount there stagnant. Because you can't afford to buy insurance, it's going to be too expensive. And you don't want to pay extra like here cash also. Now this is alternate funding, which is the sinking fund I mentioned to you just now. Alright, okay. Insurance, you find it's cheaper because the cost of premium is about 2% to 5% over the sum assured that you pay. Whereas borrowing with the bank, heftier, double digit sometimes. Okay. Plus interest, you don't pay for a few months. Worst case scenario, policy lapse. Borrowing, you don't try to pay a few months, you see. Right, they take you to court. Okay. There's higher risk, get more problems to the person. If you are doing cash installment, then this thing should be considered. How lengthy should the installment be? Okay, for the purchaser to pay. How long the period? How frequency should each installment be paid? Is it monthly, quarterly, yearly, that kind of thing? And whether you don't charge interest or not. Yes, put down the percentage. Right? For Muslim clients, basically we won't be putting interest up. Okay. And then the power of attorney that we use. A lot of clients, a lot of people that we meet now, they think the power of attorney, the moment I die, the power of attorney can't be used. Well, the type of power of attorney that we use for the buy-sell is the one that will basically last even when the client dies. Okay? But do take note, the power of attorney in Malaysia is governed under the Power of Attorney Act, but only applies to West Malaysia. Right? Only applies to West Malaysia. So sometimes when we get East Malaysian clients who's got Sdn Bhd company in Sabah, Sarawak, we just tell them your registered address is there, right? Okay, change the registered address to West Malaysia. Your operation can still be there, your COSEC can still be there, change it to West Malaysia. Okay, what address lah? If you don't have a COSEC to recommend, to go and find, we can recommend you one lah. If your firm does it, then you can ask your firm to see what 1 year you will charge how much for being a postal address and all that. Okay. Then what happens that then when the guy dies, the power of attorney can be used to do transfer shares. Okay. Because if we did try to ask the East Malaysian COSECs, can I use the West Malaysia power of attorney to go and transfer shares when the client dies in East Malaysia? I say no. They don't allow it. So that's why we have to change the registered address to be West Malaysia, just to fall under the West Malaysian ruling, so that they can use the power of attorney to transfer shares. Okay, alright. The power of attorney needed to be used because when the client cannot transfer the share himself, he needs someone to transfer it for him to the buyer. Okay, so that's where the power of attorney is given to Rock Wilson for us to transfer it for him. Alright, the power of attorney that we use will be this particular one, the last one. The first two we don't use, the section 5 and section 6 we don't use. Section 1, section 7 is the one that's suitable, where we say it's for a fixed period of time. Alright, fixed period of time. This type of power of attorney, like the name says, irrevocable. You can't revoke it unless and until both the client and the trustee agree to cancel it. And usually when do we agree to cancel it? It's always when the buy-sell agreement is terminated, then it's terminated lock, stock and barrel. If it's stated as part of the terms of the buy-sell, part of the terms of the trust deed and the power of attorney there as well.
account.